AVV Nation, what's going on? It's Patrick here at VectorVest. Hope you're all doing well here today. And I've got a brand new update for you on the whole GameStop saga. We're going to be taking a look at all the news that's been going on over the last couple of days. Also, I've got some interesting, or what I'd like to call strange trading activity that I've noticed on an intraday basis here today that I want to bring to light and share with everybody out there to get more eyes on it, because it definitely is a little bit concerning here. So if you're ready to learn, you're ready to find out what's going on, make sure, as always, smash that like button, hit that subscribe button, and let's get into it. Alright, welcome back everybody. So to get started here today, I want to take a look at the GameStop report that just got released by the SEC a few days ago and highlight a few key observations. The first and foremost is something that's been shared all around social media, and we want to start off there on page 27, and it talks about the causes of the run-up. So I'm not going to read the whole entire thing, but the main point that really I want to point out here today is whether driven by the desire to squeeze short sellers and thus to profit from the resultant rise in price, or by belief in the fundamentals of GameStop, it was the positive sentiment, not the buying to cover, that sustained the week-long price appreciation of GameStop stock. This is huge. This is basically admitting that shorts didn't really cover, even though we saw short interest drop, which I'll talk about here in a minute. But this is basically admitting that shorts didn't cover without admitting that shorts didn't cover. But let's keep going on a little bit, because it gets even spicier from here. Here comes up a graph of the short interest in GameStop. And one of the key things that really we want to highlight is this drastic drop that we've noticed from about 140% based off some of the figures that we've seen out there, down to about 20% essentially overnight. Now, if shorts didn't cover, how did short interest drop so fast without the skyrocketing in price that everybody's expecting? Well, just stick around. We'll cover that in a second. If we continue going down a little bit further here, the other key thing that we want to talk about comes up on page 30, I believe. Yep, here we go. And it talks about the failures to deliver. Now, I've talked about FTDs quite a lot over the last few months, but just want to highlight something here. The unusually high amount of short selling raised the question of whether some of the short sellers were naked, namely made without arranging to borrow the underlying security. And one of their metrics that they're using to see if there is a high amount of short selling or naked short selling is the fails to deliver. And they did observe spikes in fails to deliver in GameStop. However, fails to deliver can occur even with short or long sales, making them an imperfect measure of naked short selling. Moreover, based on the stats review of the available data, GME did not experience persistent fails to deliver at the individual clearing member level. So, yes, we know that the fails to deliver have not been showing up as much as everybody was expecting them to, and it's almost like they've been able to hide their positions somehow without actually closing it out. Well, let's go take a look at another SEC report that I have from all the way back in 2013. And this report is titled Strengthening Practices for Preventing and Detecting Illegal Options Trading Used to Reset Reg Show Closeout Obligations. And on page 7, which you can go find this report, I'll link it down in the description below. But on page 7, it talks about if a stock is hard to borrow or has a high amount of fails to deliver, how one could use possibly options trades to hide the actual fails. And specifically, the second transaction to reset the clock. This gives the exact example. If you want to go check it out yourself, by all means, go ahead and do so. But in essence, what it's saying is that rather than paying the borrowing fee on the shares to make delivery or unwinding the position by purchasing the shares in the market, Trader A might next enter into a trade that gives the appearance of satisfying the broker-dealer's closeout requirement, but in reality allows the Trader A to maintain its short position without ever delivering on the short sale. Most often, this is done by the use of a buy right trade, but may also be done as a married put and may incorporate the use of short-term flex options, which basically flex options are just options that have different expiration and strike prices. These trades are commonly referred to as reset transactions, and they have the effect of resetting the time that the broker-dealer must purchase or borrow the stock to close out a fail. So I know this has been speculated about quite a lot over the last 9 months, but this is an SEC report written back in 2013 that explains exactly how we can see this type of a graph occurring, just a straight line down and short interest basically dissipate without confirmation that shorts have actually covered. So that's going to do it for the report. Personally, just some extra thoughts on it is that every single time we get to a point where they seem to finally start picking up on some of the illegal activities or manipulative activities that could possibly be causing what we've seen the last 9 months, they seem to stop short of it and move on. So for the SEC out there, look a little bit further. Do some actual investigating. You have the report showing you exactly how these market makers and big institutions can hide their short positions. And you've even said it yourself that it didn't look like a lot of short covering occurred during that run-up. So therefore, how did that short interest drop so quickly and so severely? And finally, let's go ahead and take a look at the chart, get an update on the technicals. But while I'm pulling that up, let me know your thoughts on the report. Did you read it all the way through, or have you only read a few bits and pieces? And what are your overall thoughts on this whole report in general? So let's go ahead and jump right into the chart. So first and foremost, I want to do an update on the longer term chart. Right now, we're looking at about a 10-month graph shown in weekly candles here on GameStop. We have that wicked wedge that I've been talking about for quite some time. We can see that last week and the week before, we actually kissed the lower part of that wedge, starting to move higher from here. And looking at the technicals, we see stochastics coming out of oversold territory, starting to move up, telling us that there is more upside potential than downside risk currently. Also that since it's below that overbought territory, we still have a lot more upside to go. Also looking at the DPO crossed right into negative territory over the last couple of weeks, basically resetting that momentum indicator and now starting to pick up a little bit here. So want to see that definitely continue to move higher. And then looking at the MACD, yes, it is slowly moving down, but the difference between the MACD line and the signal line is definitely starting to converge, shown in that histogram here, showing that that downward pressure is starting to dissipate. So therefore, that's definitely a positive sign. Now, what I'm looking for is DPO to start taking a nice pop, also MACD turning positive. And the main thing to focus on is looking at the price action and seeing it break out of this wicked wedge, because as I've stated in the past, this is the biggest consolidation pattern I've ever seen in over 30 plus years of investing. And if we break to the upside of that, things could get extremely exciting if you're a GameStop owner. So final call, last chance, not financial advice, but you don't want to miss out on this potentially life-changing opportunity here. All right, so let's get into the last piece that I thought was the most interesting part of what we were talking about. So I was going over the reports. Obviously, I keep GameStop's chart up since I do actually hold it up all day. I was watching trading activity. Let's go take a look at the intraday trading activity. So this is extremely unusual to me. You see really strong volume right out of the gate going all the way up until about 10:30, and then volume just drops off like a rock. Let's go ahead, take off the MACD, the DPO. Let's go ahead, take off stochastics. That way we can see just price action and the volume here for today. So all of a sudden we had about a 30-minute gap of basically no trading or very, very low trading relative to what it's been trading at this morning. And then all of a sudden the volume starts kicking back in. You see the price rocking and rolling. As soon as it starts picking up some momentum, of course, volume just disappears. You see the stock going sideways until randomly volume comes back again. Stock runs up some more. Then volume just disappears to move it lower. And just recently, as I'm recording this, you're starting to see volume picking back up, skyrocketing price back up to those 186, 187 levels. So one theory that I have is this could be the internalization of orders that we've been talking about, or that the SEC has been talking about with the payment for order flow debate. And if that is the case, well, then the SEC needs to hurry up and start actually making some changes to this, because this looks like blatant market manipulation if you ask me. Just my personal opinion, and like I said before we started this is definitely speculation, but it seems like if buying volume gets too much and it drives the price higher, somebody who has a short position that also may be a market maker or somebody that can see the order flow coming in would have the motive to potentially internalize some of those orders, therefore cutting out that momentum that was building up. And especially since you've seen a lot of new buying coming in after the report from retail using multiple different brokerages that use payment for order flow, you could see a lot more internalization coming in, especially yesterday and today. And the reason why I suspect internalization is that this volume that we see just drop off like a rock out of nowhere, all the extra volume that's coming in by retail is getting internalized and building up to the bigger orders to make the price pop, but then also sell off extremely fast. Therefore, manipulating price, utilizing dark pools, all the stuff that retail investors have been speculating about over the last 9 months, shown perfectly here in my opinion in one simple graph. So once again, thank you all for tuning in. Let me know your thoughts down below. Do you see this on your charts? Because I've checked a few different places, about 3 different sources here today, and see the exact same patterns on GameStop's intraday chart for the day. So let me know once again your thoughts down below. As always, if you liked today's video, make sure to smash that like button, subscribe to the channel if you're not already subscribed, share this video with all your friends and family, and I'll see you guys in the next one.